This is our low-cost portfolio. It was started in January 2010. Now, the total cost of this portfolio is a little less than 1%. You have to remember, a normal mutual fund will charge you a little more than 2%. So you're saving about 1% on this portfolio simply on charges. The idea is whatever you save on charges, you make up for in returns, because that automatically translates to returns. We've invested about 4.8 lakh rupees in this portfolio. Current market value of that 4.8 is 6.8. So we've made about 2 lakh rupees. Narendra, that's close to about 15% completely tax-free on this portfolio. There are two funds. There's the Goldman Sachs Nifty Bs and the Goldman Sachs Nifty Junior Bs. So are you happy? Was this what we were attempting to do with this portfolio?
Yes, this proves the point that low-cost investing works, and it has been able to achieve the desired results. But if you compare it with 17%, 18% return which is achieved on our growth portfolio, or that actually proves and demonstrates one thing, that indexing is still, that we still haven't come to a stage, or the Indian market is still not at a stage where indexing has a very compelling case. Active management still rules. Good fund managers still handsomely beat the index by a wide margin and fairly consistently. And also the breadth of the market, my sense is that Indian market is very broad, though not very deep. And from that standpoint, the fund managers who assume risk selectively, and their understanding or knowledge or selectivity can cause a huge difference in performance. And this is what our index fund will not reflect. So the 2% underperformance despite its lower cost, which means that the a portfolio of our kind with 10-20% allocation to fixed income is also able to beat it.
So then the hypothesis, Narendra, that if we save 1% on return, that should translate to higher returns. Of course, when we said that, it was keeping in mind the fact that you have to have a very long-term horizon, and we've only had this portfolio now for 4 years. Do you think we should hold on to it the way it is and see how it plays out?
Yes, I think there are this portfolio was primarily designed that there are investors who can't choose the fund. There are investors who think that they should be investing in index funds only, and index funds only to save cost. So in that sense, it is partially able to achieve those goals. If you want to be passive, this is the way to go, and it is getting pretty close to the actively managed fund. But yes, the case for actively managed fund is still very strong and compelling.
All right, so this is our low-cost portfolio. There are only two index funds in this portfolio, Goldman Sachs Nifty Bs and the Goldman Sachs Nifty Junior Bs. SIP running in this portfolio. We'll, of course, track it, especially designed, like Narendra said, for those of you who don't want to go through the trouble of having to pick a fund and bet on one particular fund manager. This is the index that will move with the index.